Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Today, let's dive into an important topic that's on every investor's mind. With so many funds out there, where should you invest for the long term? Let's discuss this with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So first up, let's begin with the basics. There are so many funds already there and new funds are being added to the list every other day. What should an investor do?
Investors should do with very few funds. Let's just look into the principles which should guide your investment approach. First, you decide what is the long-term money, what is the short-term money. Long-term money, I think the 2-3 things which everybody should aspire for is that it should be diversified, it should be simple, and it should be low cost. And these 3 things are met by few funds, and that is good enough. You have to ask before you consider any new fund that is it going to offer you anything special which is not available in the existing investments. If it is not so, just ignore. Why mutual fund companies launch one? 2 reasons for it. It's an ultimate consumer product. People aspire for a new fund based on a story, and people buy into a story. There is a regulation which says that fund companies cannot have 2 Flexi cap funds. There's an embargo on having another one. That is why the classification was made. But there is no embargo on launching a thematic fund. There is no embargo on launching an index fund. So you can only have each of those categories. And after that, you have to really go and invent an index and then go about launching one. And then you are able to tickle investors or motivate investors or inspire investors to buy into those, and investors buy into those. Why investors also are able to buy into those? Because it's a new fund, new concept, and you don't have to demonstrate how it has done in the past because it's a new one. When it comes to existing funds, you have to go and prove to the market, to the investor that, okay, this is how we did in the falling market. This is how we did in the rising market. This is how much return we have been able to produce more over and above the index. Here you don't have to. We are launching, and so new funds are sold based on a story. Most investors' long-term investment needs can be met with 5 kind of funds, 5 variety of diversified equity fund. These are Flexi cap, the multi-cap fund, or these are all cap, or the value fund, the contra fund. And if you're a tax saver, you just have to invest in one fund. Maybe one ELSS, because they are all multi-cap funds.
Right. So you mentioned flexi cap funds, multi-cap funds, value funds, contra funds, and then ELSS.
Yes.
So if you can break down each one of them, what exactly do they do and how do they differ from each other?
Broadly, they are alike in a sense that they are diversified portfolios. They are diversified funds. They can have small cap, mid cap, large cap. Flexi cap, here the fund manager has been given absolute flexibility to invest wherever he wants to. Large cap, small cap, mid cap, depending on opportunity, and as much as he wants. So it is almost like a go anywhere fund. Multi-cap funds, there is a rule which says that at least 25% into mid cap, small cap, and large cap. And mid cap, small cap, large caps are defined by the regulator. Value funds which are aspiring to be dominantly invested in relatively out of favor, relatively cheaper companies in the market, not necessarily chasing growth at any cost. And likewise, contra funds, fund managers who believe that these stocks are being ignored by the market. Sometimes they might be ignored, they may be cheap, they may not be cheap, but he's willing to bet on that. And ELSS, I would call them as, 3-year lock-in period Flexi cap fund. In which only individuals can invest. So that gives them a very distinct advantage, which is these ELSS funds. They don't turn very big. They don't turn very big because companies can't invest. Large investors don't invest more than, in bulk.
Okay. So considering all of these factors, which of these funds, they are different in their approach. Which of these funds, if someone has to choose one of them for the long term, considering the risk and return, which one would you suggest is the best one suited for a long-term investor?
The best choice right now seems to be few multi-cap funds. Simply because ideally, few years back I would have said Flexi cap fund. Not anymore, simply because most of these Flexi cap funds, they have turned too big. and they have been forced to, or there is a compulsion for them to be substantially invested in large caps. Because mid caps and small cap, even if they take a big position, it will not be, it's unable to play a role in their portfolio. So these multi-cap funds, which are forced to invest at least 25% into large cap, mid cap, and small cap, is proving to be the best choice right now. Over and above that, if I have to choose one more fund, that will be a value fund to supplement my investment in the multi-cap fund.
Now, if you could explain what are the factors that one must consider while choosing a fund best suited for their investment horizon or goals.
One is that these are the 3-4 categories which should actually dominate 80% of your equity portfolio, 80% of your long-term portfolio. And once you have chosen that, then look for a fund which has been able to beat the benchmark, its respective benchmark. Over the last 3 and 5 years, you will be surprised that you will be left with handful of options. And so there are hundreds of funds, but you will be left with just 4 or 5 to choose from. We have a premium service, Value Research Fund Advisor, where our analysts work towards picking some funds which have these characteristics, beating their benchmark on a 3-year, 5-year basis. Consistency of style, the same fund manager still continues. So if you don't want to do that hard work yourself, come to Value Research Fund Advisor.
All right. Thank you, Dhirendra, for explaining to our investors how can they choose the fund best suited to their needs.
Thank you.
Now, moving on to the viewer's question. 38-year-old Mihir Patel says he's likely to retire by the time he's 58. Right now, his monthly contribution capacity, specifically for his retirement fund, is 35,000 rupees. He's an aggressive investor with a great stomach for volatility, or so he believes. Based on these facts, what should he choose, NPS or mutual funds? He has one multi-cap, one flexi-cap dedicated to his retirement fund only. Around the age of 56, he plans to switch from multi-cap and flexi-cap to an aggressive hybrid fund for stability. So can you please answer based on multiple parameters like growth, return, and tax structure?
If he is investing in your mutual fund well, and as much as possible, and he does not necessarily need to invest in NPS because of his employer. If his employee is providing, then go for it as much as possible, simply because this is the only tax exempt income possible for any individual. And your employer's contribution into NPS is not even considered as your income. So that is beneficial. But beyond that, if you have to choose allocating your own money into mutual fund and NPS, go for mutual fund. 2 reasons for this. The maximum investment that can be made from your NPS into equity is 75%, which means that the minimum fixed income allocation should be 25%. Second constraint is that your equity portfolio cannot go beyond top 200 stocks. That is the rule, that is the investment mandate of all the equity fund manager of NPS. The Indian equity market, the whole promise is around mid cap and small caps, or the flexi cap and the multi cap funds. Their promise lies in that allocation, not the large caps. Large cap returns you can get from the index fund as well without much of a fanfare. And with hardly a cost. So my suggestion will be that if go to the extent possible for your employer, as much as mandated, employer's contribution. Rest of it, go with mutual funds. And multi-cap, flexi-cap is good enough. And I really wonder if he's going to stay invested for next 20 years. Because going to aggressive hybrid on his retirement or becoming conservative is entirely a function of, how comfortable you are with your ups and downs. Because if you stick around for 20 years in a flexi cap and multi-cap fund, over the next 20 years till your retirement, you would have seen, 2-3 big market cycles where the market will go down by 20-30%, when the market will go up by 100-200%. And once you get used to it, because the whole allocation, and then comes how much is your accumulation in relation to what will be your income expectation from your investments. If it happens to be 1%, even an all equity allocation is fine. If that happens to be about 6%, maybe aggressive hybrid allocation, hybrid equity fund could be a little more stable allocation to have. The advantage of mutual fund portfolio against NPS is that you will not be forced to buy the 40% mandatory annuity. And that gives you ample flexibility. 100% of money is in your control. You allocate it the way you want. You want it to be invested the way you want. And you mount your withdrawal plan on your retirement just the way you want. And so it gives you ample flexibility. And given this time frame, if you start withdrawing post retirement when you have no other income, then and your gains are to the extent that it comes within the taxable limit, it's virtually a tax-free plan.
Well, that wraps up our discussion for today. We'll keep guiding you on how to improve your portfolio. Keep watching this space for more information. Thanks for watching. Bye for now.